Welcome to the Agent of Wealth podcast with Marc Bautis from Bautis Financial. In this podcast, Marc helps guide you towards financial freedom, ensure you never run out of money, and create a balance in life that prioritizes what is most important to you. Join us for this journey as Marc draws from years of expertise and guest experts to solve the multiple wealth building challenges involved in your financial life.
Welcome back to the Agent of Wealth. This is your host, Marc Bautis. On today's show, we actually have a full house of people on it. John Williams is back on the show. John, how are you?
What's up, Mark?
We also have two special guests, Anthony Faso and Cameron Christiansen. Anthony and Cameron are founders of Infinite Wealth Consultants and the host of the Infinite Wealth podcast. Anthony and Cameron, welcome to the show.
Thank you.
Thanks. We are honored to be here. Thanks for the invite.
So I know both of you are passionate about empowering families and business owners to create passive income and financial freedom using a concept called infinite banking. So I'm excited to talk about that concept. So let's get into it. Start us off with just a high-level overview of what infinite banking is and how someone can become their own banker.
Why don't you start, Cameron? But before, I know I like to interrupt Cameron. So I'm interrupting before he even says a word, right?
What is that? Yeah.
But let's talk about what infinite banking's not. I know you'd mentioned some listeners have probably heard about it. Infinite banking, it's not an investment, right? That this is more of a concept. If anything, it's used more of a cash management tool. And what that allows us to do is to invest through that. Because oftentimes they're comparing infinite banking to investments, like mutual funds or 401ks. They're two different things. They solve different problems and they use different products. So I just want to be clear that what we're talking about is not an investment. It's more of a concept and a ways that we can ideally continue to invest or spend money. And this whole time, our money continuing to compound.
Thanks, Anthony. Yeah, thank you. If someone is brand new to infinite banking, what I would say is that how explain it would be, you want to break it up into two pieces. First part is going to be the product, and the second part is going to be the process. And the product is going to be a properly designed whole life insurance policy. And when I say properly designed, what Anthony likes to tell people is this ain't your mama's whole life, right? If your parents had whole life insurance, it's not designed that way. This is specifically designed for high cash value, which is just cash inside of a policy, and for high accumulation. So we want this thing growing as quickly as we can get it. And so that's going to be the product. And then what we tell people is you're going to get 20% of your results from having that right product. You're going to get 80% of your results from the process. And the process is outlined as this, is once you accumulate cash value inside of that policy, is you've always got two options in which you can access those funds. One is going to be a surrender. But more importantly, we're going to use the loan provisions on the policy to take a loan against the cash value. And that process is, hey, what are we going to invest in? And what we like to tell people is we're going to invest in what you know the most. And so a lot of times what we talk about on our show is we talk about real estate, and we want to look for opportunities that create cash flow. And so real estate really fits that bill. And so we'll take a loan against our policy to go secure a cash flowing asset, single family residence, something like that. And the cash flow that comes off of that is then going to be used to pay the loan back to the policy.
Okay, makes sense. Let's maybe we can start with kind of like a walkthrough of how this would work. So someone says, yeah, I'm looking for passive income. I'm looking for financial freedom. I want to implement the infinite banking system or concept. Now, what do they do? So first step is you mentioned products and you mentioned strategy or actual execution of it. So we're going to look at designing a whole life policy. Is that where we're starting?
Yeah, first place.
What goes into that whole life policy that one makes it something that can be utilized as part of the strategy?
Well, number one, you want to make sure you've got a mutual company.
Okay.
Right. So there's going to be a list of criteria that you want to make sure that whatever company that you're writing with meets that criteria. And just a few of them are, number one is you want to make sure that it's a mutual company as opposed to a stock.
I'm sorry to cut you off, but there aren't many non-mutual companies that do like real whole life to begin with, right? I mean, obviously, like a lot of ULs and like would be typically out of that, but
yeah,
are there many outside of mutual companies?
I think on paper there's about 30, but there's probably really about 10 that have a good product.
Okay.
And of that, there's probably about 6 that are well suited for
The
that.
dividends are strong enough where it's making sense and you can structure it in a way.
Well, great point, John, because a lot of times the dividends come up,
Mhm.
and there's a lot more that goes in to creating the cash value than dividends. So part of it is the design, and part of it is the flexibility with some of their riders, right? So when we design a policy, what we're not doing is designing it for death benefit. We talk about your mama's whole life. We're typically solving for a death benefit. I need, let's just say $1 million is the death benefit I need. So, okay, we calculate what's the premium for that, right? We're designing it very differently. The way we do it, the client decides what they feel comfortable putting in their policy, whether it's monthly, annually, or maybe they have some money on the side. But that number is coming from them. Okay. And then what we do is we design the policy to get as much cash as possible and still be under the MEC line, which in simplest terms makes it tax free. So I've gotten some competitive cases where there's these large companies that are touting their high dividend. But when we compared apples to apples, same premiums, our design and the companies we use had higher cash value. And so the dividends are
because the cost of insurance isn't dragging it down so early. There's all those things going
you're
on
right.
there, sure.
Yeah, exactly right. There's a lot of things that go into it. The dividends are like the sizzle, right, that everybody talks about, but there's a lot more into it. I mean, because we also look at flexibility. There's pros and cons to doing everything, right? So infinite banking's great, but there's some things that aren't so great about it. We're very clear on that. And one thing that's a little different than other strategies is there is a minimum payment. There is a minimum deposit that has to be made. So we want to work with companies that have flexibility, because oftentimes we work with a client. Oh, great, I can do this every year, no problem. But then something happens with the business or a family emergency. So we need to be able to design it with flexibility. So that's another thing we look at when we're looking at the insurance company. You know, some companies, we can stop the premium with a phone call. And other companies, we can only change a premium on the anniversary. And so that's where I'm talking about, where there might be 10 companies that have a good product, but they may not be the best to utilize infinite banking. So what a client will do, well, first there's going to be education, right? Because this is something different. We just can't start a policy. We want to educate them how and why this works. And then they determine what they want to put in the policy. And then we design it to maximize cash and actually minimize death benefit. Now we have this cash value. Where we want to use this is because a lot of our clients are investors, right? The investments is they want to flip raw land, or they want to buy, what was it, uranium? You know, right? There's going to be an investment, right? So that's good. That's going to take cash. And what a lot of your listeners are probably doing, they're buying real estate. They're saving up money each month until they have enough for the down payment. Then they buy the asset and drain the account. And then they want to buy another property. So they save up money. And then when they have enough, they drain their account. The problem is they're breaking the compound interest curve every time because they're draining their account. What makes infinite banking unique, and with the products we use, is we don't withdraw the money and break the compound interest curve. We borrow against it. So the advantage to that is your money is still compounding. It's still growing. And that's because when we take a policy loan, we're not taking it from your policy. We're taking it actually from the insurance company. And they're using your policy as your cash value as collateral. So since we're not using your money, we're using their money, there is going to be an interest to it. Now, that's where people get caught up. Wait a minute, I just put money in this policy. Now to use it, I have to pay interest to borrow my own money. Technically, that's not true, because we're not borrowing your money. We're borrowing the insurance company's money. Okay. But a prime example of this, and I can like, this is what I'm doing with my daughter, is we'd set up a policy for her. I mean, that's also how we financed her education, but she's taken a policy loan. We're going to buy a rental property in Tennessee. And these properties are, it's $100,000. So we only need to come up with about 25 grand down payment. So she's taken a loan against her policy and is going to buy the property. That's going to cash flow, right? If it's not cash flowing, it may not be an asset, but we're going to take that cash flow and pay back the insurance company. And that is going to take some time, right? But when it is paid back, now she has one cash flowing property. And since we never took the money out of her account, her policy continued to grow. So it has the same amount of money that we looked on the illustration from day one, but now she also has a cash flowing asset. So then what she's going to do, I say hit the repeat button, but Cameron loves his hair and Paul Mitchell, and he likes to say rinse and repeat. So then she's going to buy a second property. Okay. But now she has a cash flow from property 2. She also has the cash flow from property 1. So she can repay that loan twice as fast. And then when she does, rinse and repeat, and she's buying some other ones. So what's happening is we're just using the cash value as a place to store cash.
Is there a point when the arbitrage makes sense? Like, like let's say the interest rate is like 5%. If the policy obviously isn't growing at the pace that the interest rate is there a point where like the policy has to be juiced up enough where it makes sense for you to pull it out versus what the loan interest rate is and how the math all plays out there?
I think you also want to look, is it the interest rate on the policy that you want to look at, or the interest rate on the asset that you invest in with the cash that comes out? That
obviously if that's really big, but I'm just saying purely just from the math of like the money coming out and this still growing. Because if it's negative, then I would think that like even just having cash might drawing it down. So is there a certain point where it makes the most sense? Waiting till the policy has a certain, like the engine is primed enough?
Very good question. The way we design it, we have people using their policy 30 days after it is issued. I see exactly where you're going, John. Now, where the real value is going to be, if we're looking at arbitrage, it's really going to be what the policy loan is charging compared to what the investment is returning. And you're right. If we get a policy loan, that is 5%. The property we're buying is cash flowing at 10%. So with this property, none of the money came out of my pocket. I'm just using the insurance company's money, right? And however long it takes for that asset to repay the loan, that none of that's coming out of my pocket. But at some point, that loan's going to be paid off. And if the asset has a high cash flow, you're going to do it shorter. But if it has a smaller return, it's going to take a little bit longer. This is a long-term strategy. You shouldn't be doing this for a couple of years. This is something that we should be doing for a long time. But to make things even a little bit cooler, well, I'm a nerd. I'm a recovering CPA. We work, as I'd mentioned, we're taking a policy loan, not from your policy, from the insurance company. Right? They use your policy as collateral. We also work with a couple banks that will do the same thing. We borrow from the bank, and they use your policy as collateral. Some of the advantages to that, the biggest advantage is the interest rate is going to be lower. The highest they're charging is 3.9. My loans are 3.25. And my policy is growing after fees averaging around 4%. And that's tax-free. But here's the cool thing. Even if it's 4 and 4, right? 4% interest charge, 4% interest earned, there's that difference between compounding at 4% and simple interest at 4%. Because as we compound, that balance gets higher and higher. So even if it's the same rate, we're going to earn more interest compounding than simple. But we can make it better. For one, by using that bank. So maybe it's around 4 or 3.5. But here's a cool thing. If we use this for an investment purpose, like to buy real estate or to buy land, anything that's going to create taxable income, we can deduct the interest that we're paying. It's very similar to like margin interest on an investment account. Same tax code that allows us to deduct it. So let's say it's costing us 4, but depending on your tax bracket, it may be 2.5 or 3%. Because some people, and I get it, they're like, I hear whole life's terrible. I don't need a death benefit, and I just want to buy real estate. Well, we've done the math and can kind of and will show you that by having that uninterrupted compound interest in your policy, you're going to end up making more money and paying less in taxes. Oh, and by the way, cash value inside a whole life policy, each state has at least some level of asset protection. For example, we're in Nevada, it's 100% protected. So we can put the money in there, protected from the IRS, protected from lawsuits, growing at a decent rate of return, and it's liquid. And really what we want people to do is, if they have an opportunity to use the money, we want you to use the money. Let's take a loan and deploy it. But if you're in between deals, the money's got to sit somewhere. So we just sit it in the policy, ready for the next deal.
I know you mentioned potentially being able to access the cash in the policy, after 30 days or a quick turnaround. One of the things that we hear from people looking at whole life is they look at an illustration and they see year 1, negative cash value, year 2, negative cash value, year 3, break even. And they're like, this is really taking a long time. What's different about the way the policy is designed? Is there a big upfront contribution that someone makes to it? Or is there something else in terms of how they can access the cash so quick?
Yeah, when you send a premium in, not a lot of people realize you can actually tell the insurance company where you want that premium applied. If you want it to go to the base premium and or the PUA rider, right? So the PUA rider is fundamental. That's an additional rider that you add onto the policy, and that shows up in or on that policy as just cash. And so when somebody's making those contributions to the policy that you just described, Mark, that is going to be 100% base policy. And that is your mama's whole life. That's what Dave Ramsey references all the time when, all the gurus out there that reference whole life and how bad it is. And I look at that stuff and I'm like, I wouldn't buy that. I'm certainly not putting my money in there. And that's the old way of doing it. The new way of doing it, or the way that we're talking about it, is completely opposite. Is we're solving for that cash value piece. And the way that you supercharge or overfund that policy is by putting that PUA rider, that stands up for paid up additions rider. And that's what creates the cash value early on. And so that's where we want the money going to early. And then once you do that, you create the cash, and now you've got immediate access to it.
Makes sense. And I know this is a strategy with a product attached to it, but there's no way to get around that this is life insurance. What happens if, let's say, maybe someone isn't in the best health? Are they just excluded from being able to use this? And then a second part question is, if the cost of insurance is going to come into play, can I write a policy on my kids and have them implement this type of strategy?
Great questions. So the first one there was, what if you're not healthy? As long as you've got insurable interest on somebody's, you can purchase a policy on them, right? And so I personally own policies on business partners, on parents, in-laws, my children. And so as long as there's that insurable interest, I could purchase policies on them. And so thank goodness I am healthy, right? So I do own my own. But if I wasn't, the first place that I would look would be somebody else, a family member, loved one, business partner, something like that. You can always put a policy in place there. And then you were talking about the cost of insurance. Mark, what's funny is that when you look at the way that we design policies is, again, the premiums are dictated by the client, right? So somebody comes to us and they say, hey, I want to put $10,000 a year into this policy. What we do is we then try to direct as much to the cash portion as possible. And so that premium part is what's fixed. What varies is going to be the death benefit portion, right? So if we have somebody that comes in, they're 20 years old, and they say, hey, I want to put in $10,000 a year in premium. I'm making up numbers here. Don't hold me to it, but this is just an example, is their death benefit might be $500,000. If somebody comes in, they're 40 and they say, hey, I want to put $10,000 of premium in, the cash value is going to grow and accumulate very, very similar to the 20-year-old. The variable that changes is actually going to be the death benefit. So when a 40-year-old, maybe they don't have a $500,000 death benefit at that point. Maybe they've only got $350,000. A 60-year-old comes in and says, hey, I want to put in $10,000 a year. Same thing, cash value is going to accumulate very, very similar to the 40 and the 20-year-old, but the variable that's going to change is going to be the death benefit. And in that case, maybe the death benefit's only $200,000. Because we're solving for the premium, right? Or we have the premium is fixed. What we solve for is the death benefit, and that becomes the variable, which is the exact opposite of what everybody else does when they typically go in there to purchase insurance. Is they say, hey, I need $1 million. Well, it's really cheap when you're young, but as you get older, that premium increases. So it's opposite.
Cameron, great way to examine the ages, because a lot of times people say, oh, well, I'm too old. The oldest policy I've written was somebody who was 77. But let's talk about health. I had a client who has Asperger's, OCD, had some anger management issues, were seeing counseling, and was probably 50 pounds overweight. Now, I'm sure not everybody here knows about that, about the ratings that insurance companies have, but when you get a policy, they put a health rating. Most people are standard, and then there's a few above standard. There's also a few below standard called table. This guy was a table 4, meaning that he's 4 levels underneath standard. I'm not going to lie, when I saw that, I'm like, I don't know if this is going to work. But when I ran it, the death benefit was much less, but he had close to the same amount of cash value. So there's a lot of misconceptions out there. This is where we're talking about product and process. The product, the performance or the rating or the insurance company you use is going to be impactful. But, strategy was really coined by Nelson Nash, and he wrote the book, Becoming Your Own Banker. And he says in there, you don't need whole life to do this. He's teaching us more as a way of thinking. And he compares different products. Whole life is the best product to use for this. But you could use a CD or you could use a savings account. You can do this process without whole life. But we can show using whole life is going to provide a lot more benefits in addition to including the growth.
You're actually bringing back a lot of memories here, because I actually got my start in the business with Mass Mutual, and it's just a hard concept to explain to people and get them to wrap their head around. And I feel like I'm in a different spot than a lot of people in the RIA space, because I felt like I've kind of bought into it. Like, I get it. Like, it's not, so people be like, oh, well, I could put it in the S&P and I'm going to get 8%. And sometimes it's just like, you can show it to them on paper and it's like, and they still can't, it's just a really hard concept for people to wrap your head around, because it's so different than so many of those other things that are out there. And it's not for every concept. We used to sell it for, there was a lot of leap people in our office, and we actually brought on this wealth building cornerstones, which is kind of like a leap, but it was a similar kind of concept.
Big fans of that. And
I think it's an amazing tool. And I think that the longevity of it and the idea of having it, having that steady growth that you can't guarantee is going to be there. Part that I'm piecing is that's all good and dandy when it comes to that part of it. But then there's you also have to have the investments outside of it. So you're saying, is it primarily real estate? Is it are there other things that people are investing in to kind of, because this day and age, obviously it's really hard to get that kind of flow outside of, just because of the nature of the market. Is there anything else people are doing?
Yeah, people are doing a lot. I wanted to address kind of the first part of your comment there, John, was, it's difficult for people to understand. I've actually found the opposite for most of our clients. Most of the clients that we work with are business owners and real estate investors. And number one concern for them is control. And once they realize that there's an account where you can put your money into it, and it does have a guarantee that comes along with it, but there's no fluctuation and they have absolute control over that account, that's really sells it for most people right there. That's what sold it for me when I came across banking, or this strategy for me personally was, you mean I can put my money somewhere now today and still have access to it? I don't have to wait till I'm 59 and a half. That was a game changer for me. So most of our clients have that mindset of, hey, I want access to this money. So most of them aren't going to go do investment accounts where they have limited access to it. Most of our clients are sitting on cash. And so what we're doing is we're comparing, hey, listen, here's what you're going to do now versus here's what we do with the insurance. And so that's going to be the first part of it. But as far as what people do with it is, we've got a podcast, what we talk about all the time is invest in what you know. And what we like to tell people is if you look at somebody that's created a whole bunch of wealth over a short period of time, like a lifetime, is it almost always includes a business and or real estate. And so those are the first two investments that we're telling people, hey, listen, this is where we're going to go make. We're going to look at your business and see where we can get a little bit more efficient with that. And then you look at real estate, you look at all the tax advantages that come along with that and the cash flow that you can create. I mean, it's crazy, right? And so like Anthony alluded to is number one is you don't want to ever just blindly jump into an investment, right? We got to do some education. We got to do some research. And so we've got to introduce people to these ideas and also give them some opportunities to learn about them as well. So.
And I'll explain a couple of ways I'm using my policy. I've used it to finance my kids' college. I've used it to pay some unforeseen medical expenses to improve my house. I mean, those are all what I would say, like Robert Kiyosaki says, liabilities, right? That's money going away from me. And this works well with that. A lot more exciting when we are buying assets. One of the things that we've been doing is we've been flipping raw land. Like I know you had Marc Bautis on your podcast. We've been doing that for over a year. I've loaned out money at 10%. I've bought rental properties. I've invested in my business when we needed some improvements. One thing that's actually interesting, I've actually bought other people's life insurance policies.
Should we say that?
I don't know if I should have said that out loud, but
okay, speaking of timeout, yeah.
But what the thing is with infinite banking, it's not an either or. We're not saying put the money in life insurance or the market or your business or real estate, that this is an and asset, that we can put it in there in the policy and invest in the market and real estate or the business. Because I had a client about a year ago. He had paid the first year's premium. He's like, the second year is coming up. He's like, you know what? I want to buy term and invest the difference. This guy was a true investor. He knew what he was doing. He wasn't just blindly speculating or picking mutual funds. He was doing the proper research. So we did the math. What he was looking at is what the policy was going to have, say, in 30 years. And he said he could make 10% every single year. He's thinking, okay, well, man, what if you can have a lot more money just investing and earning 10%, no question. But we got to look a little deeper and do the math. When we added the cost of term insurance, that definitely hindered the results. But then what we did is, what if we took the cash value we had, took a policy loan, and invested in the same thing he was doing? The first couple of years, he was ahead, right? Because there is a slow start the first couple of years in whole life, right? You put in $1, you're not going to have access to that dollar in the first year. So the first couple of years, he was ahead buying term, investing the difference. But the problem was he was investing $20,000 a year. So the most he can put into his market account each year is $20,000. When we put it in the policy, that $20,000 he put from day one is continuing to compound. So I don't remember all the numbers, but I think by year 10, he could take out $30,000 that year because of the growth from the policy. So he was buying $30,000 that year. Then eventually he was buying $40,000. So he was, because of that, because his money continued to compound the policy, it allowed him to do more investing. Plus, he didn't need the term cost. And also, the interest expense he paid on his policy loan was tax deductible. So we lowered his tax rate. But the bottom line, when we ran the numbers, and I think we did it for 30 years, he had $1 million more using infinite banking than if he would have just bought term and invested difference.
I want to go back to one thing you mentioned just on the mechanics of the loan. You gave the example of someone not using a concept like this, right? They save up some money, they buy real estate. Then they deplete their money. They got to wait till they save up some money, buy another property.
Mm-hmm.
What does the loan look like in terms of, is it paid back on some amortization schedule? Does it operate like a credit card where at any point you can check and see how much you're able to borrow? And that's whether you have money out already, or is there some limit that says, nope, you have a loan, can't do anything until that loan's paid off? What's the actual mechanics of how that loan works?
Sure. So essentially, when you've got cash value in there, like we alluded to earlier, the insurance company is essentially extending you a line of credit equal to that cash value amount, right? So if you take a loan for 50% of your cash value that's available to you to go make X investment, is number one, that loan interest, right? That at 5%, it's being charged on the outstanding money, right? It's a 5% annual loan. You actually dictate any sort of loan repayment that goes back to that insurance company to pay down that loan. And so one of the things that we always tell clients is I'll tell them, hey, let the asset dictate what your loan repayment schedule is going to be. If you got monthly cash flow, great. If it's a fix and flip and money's outstanding for 4 months and then you sell and you got all the proceeds, let's pay everything off at that point, right? So that's kind of how that's handled, but there are no penalties for paying it off early. Every time if somebody takes a loan against cash value and they make a monthly payment of $1,000 towards that first loan, is they have access to that $1,000 that they just paid back. So there's no kind of scorekeeping there, right? As you make a loan payment back and you create that cash value again, or you decrease the loan, you have access to it over and over again. And so I hope that answers your question, Mark.
To confirm, theoretically, even as you're taking a loan out, you're making premiums, you're having dividends, there's interest on the policy. So that max line of credit is theoretically always increasing over time. Is that correct?
Mm-hmm. Exactly. The terms of the loan, very similar to like a home equity line of credit, where it's a line of credit. If you don't use any of it, there's no interest. And if you do, the interest will only be on what you used. But what some of the difference is between a home equity line of credit and a policy loan is your policy loans are not reported on your credit. So if you take a loan out and you repay it, that's not going to affect your debt to income ratio. Also, we have an increasing balance. Because I have a HELOC on my home, but it's locked. As the value of my house increases, if I want to increase a line, I need to go back to the bank and ask permission. The whole life, as you'd mentioned, Mark, it's going up every time I make a premium. And when I get my dividends and interest, it's going up. So your line of credit automatically increases. And on policy loans, interest is due annually. And we recommend people pay it. For one, if we're using it to buy an asset, we can deduct it, but we can only deduct it when we pay for it, right? We actually have to cut the check in order to deduct it. But also, if you don't pay the loan or you don't pay the interest, they're just added to the loan. So if you're in a bind, I've had this where people are flipping properties. So they took that money out and there's no cash flow that they can use to repay it. There will be when they sell it, but sometimes that takes longer than they expect. They don't pay the interest. They just add it on the loan. And then when they do sell the property, then they go ahead and pay it. So it gives you a lot of flexibility with the loan as far as not being on your credit and flexibility on repaying it.
Going back to the design of the policy, I see a lot of people that they want to say, okay, I have this much cash, but they might not want to commit that same amount every year. Is there a way to design the policy where maybe there's a big a big upfront chunk that's paid, but something less ongoing, year after year after that?
There's a lot of ways that we can design the policy. And as I said earlier, before we hit record, infinite banking is all we do. We may point people in some directions, but we're not experts in real estate or 401ks or IRAs or mutual funds. We're an expert in our sandbox, which is infinite banking. Most of the time we design it where, all right, we're going to put in so much a month. But as you mentioned, sometimes people have some extra cash. And we have some options with that. We may be able to put that in a one-time deposit in your ongoing policy. But also one thing that happens is maybe people have a policy or two, but then they get this windfall. right? Maybe they sold their business, or they sold a property, or they pulled some equity out of one, or whatever, but they have this windfall and that's it. They can't commit to ongoing premiums. Well, we have a policy design that we call one and done. I just made that up. This is the first time you've heard it.
We do?
Okay.
Wow.
All right.
No.
Where you make one single deposit and that's it. No more premiums are required. This design is pretty special where you can have liquidity of about 95% from day one. But one of the downsides of that is you can't put any more money into it. Right. So what we will do is kind of figure out the design. And sometimes we do multiple policies.
Right.
A lot of options.
Yeah. All right. So we're just about out of time. Anthony Cameron, thank you for being on the show today. You gave some great info about the infinite banking concept, how it can be applied, financial freedom, passive income. I think that's, hot topics on people's minds today. How best can someone reach out to you, find out more information about what you guys do?
Yeah, if they want to reach out to us, they can go to infinitewealthconsultants.com. There's our website, but also we do have an online course that explains infinite banking. And so as kind of a thank you, what we'll do is we'll extend kind of an offer to your listeners. Is typically we charge about $500 for access into that course. But as a thank you for having us on, we'll give you a free link. And so we'll make sure that we get that. So if somebody wants to go to infinitewealthcourse.com/agent of wealth, that'll take them to the landing page where they can kind of get in there. There's no sales, right? It's all just education. Some of the videos that Anthony referenced today, as far as just doing the math, they'll find those in there. And so it's all education, and that way somebody can figure out if it's for them or not.
When you go to that webpage, there is a link for a discovery call, because there's probably people like, I don't know if this is for me. You probably got some questions. So we can hop on a call, answer those, and kind of see if this is a good fit. This isn't a good fit for everybody, and we're going to be very clear if it's not a good fit for you. But if it is, then we're kind of show you how you can learn more.
Perfect. And we'll link to all that in the show notes. So yeah, thanks again. And thanks everyone for tuning in to today's episode.
Thanks, Mark.
Thank you for listening to the Agent of Wealth podcast. Click the subscribe button below to be notified when new episodes become available. The information covered represents the views and opinions of the guests and does not necessarily represent the views or opinions of Bautis Financial. The content has been made available for informational and educational purposes only and is not intended to be a substitute for professional financial planning and investment advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investments and financial planning.